Global financial markets operate at a speed that borders on the impossible. Billions of dollars cross borders in milliseconds, traded by supercomputers executing algorithms faster than a human can blink. It is an environment engineered to be imposing. Yet, the person who unraveled the rigid architecture of India's retail trading industry didn't come from Wall Street or Dalal Street. He was a high school dropout who decided the entire system was running on the wrong source code. For decades, the financial sector operated on a strict set of prerequisites. Getting a seat at the table required an elite university degree, significant generational wealth, and years spent quietly climbing the corporate ladder. Legacy brokerages and massive institutions functioned like fortresses. The sheer complexity of the paperwork, the opaque fee structures, and the intimidating atmosphere of trading floors acted as psychological barricades to everyday retail investors. These barriers existed for a specific reason. By keeping the mechanics of investing deliberately complex, the established players ensured that the profits stayed concentrated among the insiders, leaving everyone else locked out. The standard trajectory to counter this exclusion usually begins here. The strict structure of a conventional classroom, focused heavily on compliance and rote memorization. He chose to walk away from that entirely. Leaving school at 17 meant trading a predictable, mapped-out life for a completely unstructured reality with zero safety nets. Without a curriculum to follow, his education shifted to observation. He started looking at the macro-level systems that actually drive the world, how supply chains, energy grids, and human behavior intersect in real time. Stepping out of the formal education pipeline allowed him to see the market without the blinders of traditional financial theory. He had to unlearn the accepted limits before he could build something new. That observational phase quickly gave way to the deeply pragmatic, high-velocity world of active stock trading. The trading floor replaced the classroom. Here, the feedback loop is immediate and entirely unbiased. Every decision you make is instantly graded in real dollars, punishing mistakes with brutal efficiency. Surviving that environment required mastering asymmetric risk. He learned to identify specific trades where the maximum possible loss was strictly capped, but the potential profit was highly magnified. By grinding through thousands of those transactions, he saw exactly where the friction lay. The existing brokerages were consistently extracting massive, hidden margins from their own clients on every single trade. This graphic shows exactly how the old model functioned. Whenever a retail investor tried to buy stock, their capital was incrementally drained by account maintenance charges, software usage fees, and high percentage-based commissions. His technology-first solution bypassed all of that. He launched a discount brokerage that stripped out the physical infrastructure and eliminated the percentage-based commissions entirely, replacing them with a simple flat fee per trade, or no fee at all for long-term investments. Look at what happens to this chart when that friction is removed. Without those prohibitive costs, millions of younger, first-time investors flooded into the market, driving exponential growth on the platform. By slashing the cost of entry, his platform forced the entire industry to adapt. Millions of people who were previously priced out were now actively participating in the nation's economic growth. The standard playbook for ultra-high net worth individuals dictates a sharp retreat from public life, managing wealth from behind the closed doors of private family offices. Kamath took the opposite approach. He actively records podcasts, hosts in-depth interviews with other tech founders, and maintains a highly visible, accessible public profile. This visibility is a deliberate strategy. In a rapidly evolving market, continuous conversations with other builders, combined with targeted philanthropic work, function as a massive real-world research network to keep his knowledge base sharp. In the modern economy, true longevity relies on building robust, open communities rather than fiercely guarding proprietary secrets. This scale of development is mirrored by the volume of capital now moving through the exchange. By removing the traditional toll booths of entry, he turned retail trading into a mainstream economic force, with millions of new accounts contributing to daily market liquidity. The core operating philosophy here is patience. Building a sustainable ecosystem requires ignoring the temptation of short-term revenue spikes in favor of designing systems that work for the end user over decades. That mental model, questioning default assumptions and intentionally designing out inefficiencies, can be ported into real estate, healthcare, or any deeply entrenched industry. This level of access changed how a generation views risk. They have transitioned from passive observers to active participants who demand transparency and take ownership of their own financial education. The financial landscape has moved past its gate-kept history. Today, a connected generation enters the market armed with tools that fit in their pockets, operating on a level of transparency that was previously impossible. Those imposing fortresses that once kept the average citizen out have been successfully bypassed. The gates are permanently open. The assumption that playing it safe and adhering strictly to traditional paths will guarantee success is rapidly failing. In an environment that rewards agility and innovation, doing exactly what everyone else is doing is actively dangerous. Which leaves a final, crucial question. What if the highest risk you can take in life is refusing to step off the heavily worn path?